Thank you to everyone for joining us today for today's webinar, Business Risk Review, looking at October. Of course, we've moved to a monthly format based on so much data, the need for data in today's economy and I guess the conditions that come with COVID, and plenty of feedback from our loyal webinar attendees, yourselves there. So thank you very much, as always, very much open to questions and answers. All right then, let's kick off. So business risk review for October. Thanks again for joining us. Of course, we're CreditorWatch, Australia's most innovative and largest credit reporting bureau, over 50,000 customers with a wide product suite. As you can see there, we've got a new way of displaying it all through the whole, showing you through the whole customer journey and the types of products that you can utilize via CreditorWatch, whether it's onboarding clients in a more automated fashion with Apply Easy, of course, our online credit application, a wide variety of assessment and analysis tools from credit reports and credit scores, which we now call Risk Score. Hopefully you all saw the release of that this week, and I'll touch on that very briefly. We do have a webinar on Monday to go through more information. Portfolio Health Check, really powerful tool at the moment. Provide your age trial balance, and we can actually come back to you with a really clean analysis of which customers are paying you well versus the market, and of course the other way around, which of your customers are slowing payments elsewhere and potentially paying you even slower than the market. So a great way to prioritize collections, but also minimize and mitigate credit risk. And we all know that payment times, very important indicator of oncoming delinquency. Some key highlights that we like to pull out and show, just to give you a better understanding of the type of data, products, how it's all coming together that is ultimately CreditorWatch. So over 50,000 customers, as I said, so really important data coming from you. If you are a customer, credit inquiries, payment defaults, trade payment information, that sort of thing. We've sold over 11 million credit reports since launching, gives you an idea of how many people are accessing our data. 90% of our customers are unique to CreditorWatch, so that means the data that we're collecting from our customers can't be accessed anywhere else. So it's giving you that really important, unique and predictive insights into credit risk. Are you dealing with good customers, bad customers, average customers? So plenty of information all coming together and plenty of information going out to our customers as well. So ultimately, what is the business risk review, which is what we'll be looking at today? It's a monthly analysis of an incredible amount of data that we're sourcing from a variety of sources across private, public, and also government sources. So the likes of ASIC, APSA, we're showing business register. Of course, I touched on our customer data that is being shared with us, but more past that as well, courts, insolvency notices, debt collectors, debt collection actions, ANZIC data, huge range, growing, every quarter. We're always on the lookout for more data sources. If you've got any ideas, of course, please let us know. Potentially you operate in a specific industry that might have its own data sources that we can get access to. We're always open to have a discussion and look at how we can integrate that into our bureau. So let's get straight into it. Big number here, payment defaults for the second month in a row have increased. We've seen a big jump this time, 68% increase from September to October. Look, what does this mean? It could be the start of what we expect to happen, or it is the start of what is happening, which is there's been a big backlog in defaults. They've been down, sort of anywhere from 25 to 50% when you compare it to the same month last year. It was only inevitable that these defaults started to build up and ultimately, like a champagne cork, would pop. And potentially we are seeing that in October. We do see companies register defaults, on a quarterly basis. So potentially we'll see a bit of alignment with that. But the big one to watch will obviously be November. But it's really important to note that these payment defaults are being registered. It's a really key indicator that a company could be going into administration. So if you are getting alerts for defaults on your customers, it is certainly something that I encourage you to take a close look at and understand what is your exposure to that particular company. Looking at payment times, really, really important indicator of, as I said, delinquency, credit risk. So we'll go through the best performing industries here, which haven't changed much from last month. Mining stays overdue, fantastic, you're dealing with miners. Information, media, and telecommunications at 11. Agriculture, forestry, and fishing, which is fantastic news after doing it so tough for so long. You know, they are starting to see the fruits of the rains that have come through. Of course, there's always sections of, you know, the ag business and farmers that are struggling, and then they've got to contend with, you know, political issues and situations like what we're seeing with China, and of course, even things like the docks being backed up as a result of, you know, protests and walking off downing tools, so to speak, by the unions. But great to see payment times in that space performing really well. Most impacted, transport, postal, and warehousing continues to be really impacted, with numbers blowing out at 90+ overdue. No change from last month, and a huge increase on October 2019. Financial services, no surprise there, but the good news is it has improved by 17 days. So we know that there's plenty of media out there. Plenty of the banks are coming out and saying, look, deferrals are coming off at record numbers. So many people are getting in contact rather than having to be contacted. So there's really good proactive customer engagement where they're coming back online. In a lot of cases, we're also hearing about, you know, tier 2 banks reporting that customers are actually paying back the deferrals that they've missed out on for, say, the last 3 or 6 months. So they're actually in a really positive cash position to actually make the payments that were deferred in previous months, which is great to see. And that is across, of course, consumer and commercial. And then healthcare and social assistance, we've seen an increase of 8 days versus September last month. Most improved industries, financial services I've touched on already, financial and insurance services I've touched on already, I should say. Some really good news here. Arts and recreation, 16-day improvement, which is fantastic to see. They've certainly done it probably even tougher than food and accommodation, which we've seen an improvement of 13 days. You know, with Victoria opening back up, our team has certainly been out and about, and I've got family down there. There's plenty of them who are taking the opportunity to get out there. You know, when we saw in March and April this panic buying, you know, of toilet paper and food and fruit and meat and canned goods and whatnot, and you know, that they reported on the fact that, you know, that panic buying kept the GDP at a high level. And I think they have even increased it. I wouldn't be surprised if the Victorian activity and the Victorian public going out eating and drinking and going to cafes, of course they love their coffees down there, buying coffees, that we see a significant impact from that activity on GDP. Of course, a little tongue in cheek there, but genuinely feel that, you know, they were cooped up for so long, which is so unfortunate, that, you know, they couldn't wait to get out there and socialize and just get out and be a part of society again. So it's great to see that. It's great to see those two second industries there as well, seeing improvements after doing it tough, really, from March, when everything started to shut down. So having a look at September versus October numbers, 14 out of 19 industries we saw an improvement, which is fantastic news. That is on top of, I believe it was 11 out of 19 last month. So if we can continue that trend, it certainly bodes well for Christmas time and then moving into the new year, which no doubt everyone is hanging out for. Year on year, there's still significant increases on October 19 versus October 20. However, there are a number of industries that are starting to get back down to where they were this time last year, as you can see, mainly on the left-hand side there, but also accommodation and food services as well, which is fantastic news. Court actions still very much down on the same month last year. This is due mainly to a number of reasons. One, COVID restrictions make it harder to actually get cases through the courts as quick as previously before, and we still have a number of courts either being closed or on limited duties. So no surprise there that Victoria has the biggest backlog, but a little bit surprising that Queensland is so down on October 2019 as well. External administrations. This has really been, the barometer in the media around, how are companies performing. You can see that, in April straight away, so late March is when, COVID really hit, and we saw all the lockdowns and restrictions come into play. So it's no surprise that there was a big drop down in April when safe harbour provisions were introduced. There was slowly crept up, but still, really low numbers through to June. And of course, once Victoria went into lockdown, we've seen it just plummet again, which is a false positive really, because we know that there are tens of thousands, if not hundreds of thousands of businesses out there doing it tough. We started to see a jump in September, which I felt was the start of, seeing some of that normal, month-to-month administrations that usually take place, which is usually up around that 800, 850 mark, start to work its way through the pipeline. But we've seen a really big drop off again in October, which I struggle to sort of put a reason on. All eyes will certainly be on the government and on the media as to when they'll call or make a decision on whether safe harbour provisions will come to an end at the end of December, 31st of December. That is really going to be a big test and will determine whether we see an increase in administration sooner rather than later. Looking at October 2020 versus 2019, we're down 62% year on year for October, which is just a huge number. Looking at month on month on the right hand side here, September to October, again, it's a drop of 26%, which was really quite shocking. Having spoken to a lot of people in the industry, no one really expected that. The only thing that they could potentially put their finger on was that school holidays slowed down the normal sort of rhythm there. Looking at states, of course, New South Wales leading the pack as they usually do. No real interesting stats coming out of this. Even Victoria didn't see a big increase in administrations, despite the pain that the companies were feeling there. With people, with directors and companies able to hold out and wait for safe harbour decision to be made, there's really no big incentive for them to actually wind their company up or go into voluntary administration. So as I touched on, safe harbour provisions are still very much in place. My personal opinion remains that they will extend it past the 31st of December. I don't think Victoria or Victorian industries will quite be back on their feet, and the government won't necessarily have the economic numbers to support ending it. I am softening on this somewhat, having spoken to a few various government organisations, departments and people. The cynic in me thinks that the last thing ScoMo and Frydenberg would want is, front page headlines saying record numbers of insolvencies expected or are happening, in December around the Christmas period, if they do commit to ending safe harbour provisions in December. Treasury are on board with ending it. However, if you're a politician, particularly those top two, they're certainly being held in high regard at the moment. I think they've done a very good job. It would be quite a sour way to end the year if they, if they did end it and we saw a big increase in administrations or a backlash. Not a nice way for them to end the political year. Not a nice way to sort of go into Christmas and New Year's. Anyway, that's a cynical personal opinion from me. As I said, I am softening on this, so it will be interesting to see when they make a decision. They can't leave it too late, as people need the ability to start engaging and working out exactly what they need to do in order to either wind the company up or engage with restructuring specialists. Of course, we do have those new insolvency administration legislation coming in for small businesses, those with liabilities less than $1 million. So it could be a perfect sort of storm or lineup, not storm rather, a perfect sort of transition from safe harbor being ended on the 31st of December and then having the ability for small businesses or those with less than $1 million of liabilities to start engaging in a more streamlined and affordable approach to administration. So bad news, good news, just as a bit of a recap, payment times have still certainly blown out compared to the same time last year, but we are, of course, seeing really good improvements. So that's good news down the bottom there. 14 out of 19 industries saw payment times improving month to month, September to October. Administrations dropped again versus last month. I know this is in the bad news and it sounds like good news, but we know that they are going to happen eventually. And if we can flatten that insolvency curve as much as possible, it puts less pressure on creditors, puts less pressure on the insolvency industry, and of course less pressure on ASIC, and really importantly, confidence as well. The last thing we want to see is thousands and thousands of companies going belly up, you know, all at once. It certainly doesn't create confidence that, you know, we're starting to sort of feel again in the economy, in the supply chain, in the country in general. What's next? So some things to obviously look out for other than the safe harbor provisions coming to an end or being extended from the 31st of December. If they do extend it, we really do have the potential for a March cliff with JobKeeper, JobSeeker, rental abatement, you know, loan deferrals, all of that sort of thing happening around that sort of that March month, that March timeline. It's a lot to take in, and basically it removes that sort of safety net, safety blanket, the synthesized, stimulated economy all at once. The danger to that, of course, is that we see a March cliff or a big wave of insolvency occur, and off the back of that, of course, an increase in joblessness, which is certainly not what we want. It puts more pressure on the government, and ultimately it is not good for any industry, nor for the people that might find themselves without a job. But we do know that we are in a stimulated economy at the moment. It isn't real, and it has to end eventually, so keep an eye out for that. Safe harbor will end, of course, so brace yourself for that. And as we're always saying, to use the term that's probably been used way too much, is zombie businesses are out there. Do you know who they are? Have you tried to identify them? Of course, that is something that CreditorWatch can assist with. Don't be shy to get in contact with us. The next big, bright, shiny thing, it's been a big sort of 3 or 4 months. You know, we've moved the business risk review to a monthly rhythm away from the quarterly rhythm. We introduced Harley Dale as our chief economist, and he's been great. He's been in the media a lot, provided a lot of commentary and content. And we launched the new risk score, CreditorWatch risk score this week, and then we've also got the business risk review as well, which is an interactive site, which I will take you to now. Great way to sort of engage with the data that we have. For example, you can click on payment defaults, have a look at how the changes occurred from month to month, going back 12 months. You can even look at individual industries to see which industries are being affected the most, which is a big shout out to the dev team. Our dev team have worked tirelessly on this, and it's certainly a fantastic website that I encourage you to jump in. Sorry, premature there. Let me get rid of that. We look at court actions as well, how they're trending. No surprises there. You can see the big cliff from March to April. You can even look at state breakdowns too. So really nice interactive graphs for you to take note of, depending on what state you're in, where your exposure is. Administrations, again, industry breakdown, state breakdown, some fantastic data for you to take in here and take advantage of. So this will be updated on a monthly basis. In time, we will look to update it even more frequently, potentially than that. And we do have a number of other insights that we will be introducing over the, over the coming months and year as we get access to more data, as we find more insights within our data. There'll be plenty that we can start to have a look at. So some great stats coming through, even from a payment times perspective. So jump on there. That can be accessed within the slides, creditorwatch.com.au/business risk review. It's also available on the website here in the latest news and articles. This is the homepage. You can jump on there. The other big thing to announce, of course, is CreditorWatch Risk Score was launched. There's a video there if you want to watch my face. The lighting that they had set up really brings out the orange in my beard. But if you want to just get into some more detail, jump on the blog. We've got a number of articles there. So we've got taking the risk out of commercial credit management that looks at, what is risk score? How is it combined? Who is it beneficial for? How does it work? All of those sort of things. Plenty of information in here. We've got a couple of case studies based on different industries and a great piece that you can download as well. That will give you an even better understanding of how the score has been produced. Jumping back, business risk review is up there on the blog as well, so you can delve into the data that I've just been talking about. And Harley Dale, our chief economist, has also provided some commentary as well around the numbers that we've seen, but also including things like GDP, RBA decisions, and what we can expect from the government stimulus going forward. So that brings us to the end today. What I did want to ask though, as always, if you'd like to be contacted, please let me know. I'll throw up a quick poll here so you can jump in and say yes or no. Don't be shy to say no, of course. We like to be able to, contact those people who are interested in speaking to us. Doesn't have to be about the business risk review. It could be about the score. It could be about our products. It could be about talking about the economy in general. We're always open to chatting, so please don't be shy. Love to know if you do want to hear from us. Let us know. Click the yes option there. If you're not interested, you can close it off or click no, of course. As I said, we do have a webinar on Monday going through the risk score that we've launched. Good opportunity to ask questions, great opportunity to really understand why we introduced it, how it works, and how to really read it. It is very simple. We've got obviously the score that we've always had, but we've introduced ratings, which is a great way to compare entities, different entity types, sole traders, trusts, partnerships, public companies, private companies, all that sort of thing. So I do encourage you to jump on there and have a look. You can see more information, of course, on our website by going to webinars. Here we go. creditorwatch.com.au/webinars, and you can register for the introduction to CreditorWatch Risk Score on there. Bit of a spiel about what to expect from it. There you go, plenty of it. We're lucky enough to have Open Analytics founder and MD James O'Donnell, who was instrumental in developing that credit risk score for us. Rather than hearing from me, we'll hear mainly from him around how it works and the benefits of it, of course. So thank you to everyone for joining me today. I hope you got something out of it. I hope it was beneficial for you. Of course, don't hesitate to contact us if you have any questions, and we will go back and see you soon. Thanks very much.